We've had this almost perfect V, right? From the beginning of December, the stock market goes down. Worst December ever, one of the best Januaries in memory. And now where are we, right? We've kind of undone the panic from December. Some of the most beaten up stuff that led the way higher in this rebound, maybe stalling out a little bit. So where do you think that leaves the market in terms of where we get from here?
Yeah, I think that's a perfect way to describe it. I mean, if you look at where the market is today, we're essentially at the averages of November. So it's almost like December never happened, which I think makes a lot of sense from a fundamental perspective. Not that much was going wrong in December, so therefore it didn't make sense to have that type of, crazy violent move in the market. So we're back to where we were in November, and I think, from here, maybe there's a little bit more upside from here, but I think the reality is the force that drove January is it's petering out, and I think the force that's going to drive markets for the rest of the year is one of slowing profits growth, and I think that's going to be the focus of the markets. And I think history tells you that it's unlikely that the cyclical high beta outperformance that you've seen is going to last for the rest of the year if profits growth continues to slow, because the cycle by definition is defined by the cyclicals, right?
Right. So basically, profit growth for 2019 right now, forecasts have been revised down. Are they looking mid-single digits perhaps?
Right.
For the first quarter, it's near zero.
Yeah.
What does that tell you in terms of where you want to be positioned, if not in cyclicals? What types of stocks?
I think when the profit cycle slows, you want to move away from cyclicals, away from high beta, and move up the quality chain. So at RBA, we're focused on high-quality companies with large balance sheets and stable growth. I think those are the key themes that people need to focus in their portfolios and not get faked out by this January rally, which is kind of the opposite of those types of companies.
What kinds of sectors, though? Or is it agnostic of sector?
Well, to some extent, it's the quality aspect is probably more important than the sector aspect of it. So just any company, it doesn't matter the sector, that has stable growth attributes, strong balance sheets, good returns on equity, I think that makes a lot of sense. But from a sector perspective, a lot of those companies will tend to fall within, say, healthcare and staples. And even utilities, the reason that we're not more bullish on utilities is we're a little bit wary of how far rate expectations have come down, and they tend to be pretty rate sensitive. So we're a little bit more lukewarm on utilities relative to healthcare and staples.
NASDAQ up 11% in January. So, Dan, is that it? Sounds like you're telling Mike that's all she's got.
Yeah, I think from here, like I said, maybe there's a little bit more room for those guys to run, and that's going to be driven more by sentiment if it continues to run. But I think underlying this is going to be really this focus on companies that have stable growth, because as growth, people underestimate how cyclical tech really is. Tech is, when I was at my old firm, one of the reports I put out, we looked at, how each sector and each industry, how sensitive they are to the economy, all these different economic factors. Tech, surprisingly, had the highest earnings correlation relative to ISM and a lot of these cyclical indicators, more so than industrials and materials, which a lot of people don't realize.
You like China, though. So is that a planned positioning? Because we saw positioning get us a long way from the December bottoms.
Yeah.
So China's really out of favor.
So at RBA, the three things we focus on most are profits, liquidity, and sentiment. And sentiment for China is probably close to as bad as it's been. I mean, it's gotten a little bit better. People, really it's been at the epicenter of the fears of global slowdown and trade wars. And so I think that is very positive for China. Liquidity, they're actually pumping liquidity into the system. And then from a profits perspective, yes, the current hard data coming in is very weak. But we're getting a lot of green shoots out of China, more so than everyone else. I think that's a representation of the fact that they're bucking the trend globally. Everyone else, from a fiscal monetary perspective, is moving toward a tightening bias, where China is starting to step on the accelerator pedal.
So, Dan, you seem very rational. You would never make it in Congress. So, but you're focused on profits, which makes a lot of sense. What about in the political realm? We had a government shutdown. We have trade negotiations with China. We have NAFTA that needs to be reaffirmed. We had the president having dinner the other night with the chairman of the Fed, raising questions about independence of monetary policy. What in the political world would upset your forecast for the next year? What are you most worried about coming out of Washington?
Well, I think, one of the biggest risks, for 2019, I mean, there's upside risks. As I mentioned, we talked about China, but the biggest downside risk is just shooting ourselves in the economic foot, right? I mean, policy has the biggest chance of derailing that profit story that we're talking about. I mean, right now we're looking at profits slowdown, not a profits recession. But policy, I mean, if we don't get trade resolution, if we have another sort of a policy misstep on the oil front, I mean, it's very possible that we could have a profits recession, which would essentially mean that, what we saw in December was actually a good foretelling of what could happen for the rest of the year.
So policy instability or uncertainty is something that could be a little bit of a headwind.
Yeah, I mean, even with the shutdown, I mean, most people weren't focused on the fact that there was a shutdown, that we couldn't get a deal. But even Fitch came out and said, if this keeps going, we're going to downgrade the U.S. credit. And I think that is when it starts to see the tipping point of having real effects on the market and real effects on the economy.